Welcome, everyone, to another episode of the CFA Society of Chicago Macro Matters podcast. My name is Rich Excell, and I am once again glad to be joined by my co-hosts, Tony Zhang and Blaine Reed. Thank you guys both for joining me.
Hi, Richard Blaine, and so glad to see you guys again after a long time. It's hopefully you guys enjoy your summer. I think that at least the market really went through a roller coaster and coming back up to where it was at the beginning of this year. I think there will be a lot of exciting things to discuss.
Absolutely. Thanks, Rich. Thanks, Tony, and glad to be here and see you guys as well.
Yeah, it's been a few weeks. Sorry for the delays, but we've had some travel, etc., going on, which always helps us kind of inform our views and things of the. It gets us to ask some questions, and we'll try to dig into a lot of those things. Um, Before we dig into some of the topics we wanted to talk, I wanted to maybe, Blaine, since we have you again, start out by talking about the private credit markets, etc. This is a topic that we've wanted to cover on Macro Matters before. I don't really have any good charts to show you. Everyone knows I like to show charts, but anecdotally, I know in a lot of conversations, as I was telling you before, everyone seems to be waiting for that bubble to burst in the private credit markets. And we've seen some headlines that suggest that maybe banks are taking back some market share, et cetera. I know when I did the podcast series on private credit a few years ago, a couple of years ago, I should say, no one in the market thought there was going to be any sort of risk. Here we are a couple of years later, and rates are still as high as they were. They're not, maybe they've come down a tad, but there's, and we've got 3-year private credit, obviously seem to be rolling 3-year loans that they need to, I think there was probably an expectation in the market at that point that they'd be refinancing here at lower yields, but that doesn't seem to be the case. So, from your seat, Blaine, what are you seeing and thinking and hearing about the private credit markets?
Yeah, sure. I think that's a great topic to start off with. I think first and foremost, in the broadly syndicated market, just to maybe go there real quick, up until probably maybe this week, last week, it's been pretty benign. The issuance cycle there had slowed down, and I think that's probably due to some of the things we've talked about on this podcast in the past, and everybody's well aware of with some of the headlines out there. And with that, what we have seen as it relates to private credit market is some issuance trying to come back to the broadly syndicated loan market. So deals that maybe were lost or would have been done in the broadly syndicated loan market a couple of years ago went to private credit. Now with the kind of lack of new issuance in broadly syndicated loans, that creates a competitive environment for borrowers then to go back to maybe the broadly syndicated loan market, save a point and a half, 2 points in some examples on their coupon costs. And so that becomes attractive. And I think that's driven a lot by just the CLO issuance. There's still a fairly robust CLO issuance going on this year. And that just creates demand for product, and then thus banks are out there looking for issuance to put out there for the CLOs. So I think that's one.
Can I just step back a
Yeah.
second, just for the listeners that are not necessarily as familiar with the terms of the when you're talking about the broadly syndicated loan market and
Mhm.
CLO issuance, these are markets that are essentially raising money to invest into bank loans and things like that. So this is going to essentially benefit the JP Morgans and cities of the world, and not necessarily private credit. Is that right?
That's correct. Yeah. So it's still an underlying leveraged loan. It's just a matter of whether it gets syndicated out to oversimplification here, but whether it gets broadly syndicated to a larger lender group in the broadly syndicated loan market, and that's where CLOs are part of that, or it gets done in private credit, where it could be one lender or a group of small lenders, three or four, that it gets put into versus broadly syndicated. So, but still underlying leverage loans. And some of the terms can be, different of the actual loan itself between the two different markets. But that's what I mean when we've had this kind of lack of issuance in the broadly syndicated loan market. There's still a demand, and so it gives some competition to for the borrower, the lenders themselves. So, and that's kind of what we've seen. There's a Bloomberg article mid-May, I recall, about a company called Alara Group that was done. I think it's a $4 billion loan that was done in private credit that was being brought back to broadly syndicated loan, for instance. So we're seeing some of that. And I think your other point on just kind of risks in private credit, those are still, I think, yet to be vetted out. But I think that is certainly a concern when you're talking about levered credit in amongst some of the headlines that we've seen, and how tariffs, for instance, might impact just everything that relates to revenues, EBITDA, where leverage is on these companies, and downgrade risk, where these companies are then valued going forward, and who bears that risk in the private credit market, and how willing and able they are to carry that risk forward. Because that is one of the pluses of private credit is that they, in a smaller lender group, you can work with companies that maybe have a quarter or two of missed earnings or weakness. It's easier to work in a smaller lender group than it is in a broader lender group. So there's some of that counterbalance in private credit, but it's how long can they keep that up, and in a potential recessionary environment, which is yet to be come, but that will be tested if we get to that point, I think. So yeah.
Yeah, for sure. The trends we've seen the last few years is that because of the regulatory environment, a lot of the banks were not able to release this balance sheet, if you will, into that loan market. And so that really created an opportunity in the post-GFC world for these private credit funds to kind of step up and step in. And a lot of it maybe initially started kind of replacing the regional banks, if you will, the ones that, the super regionals, et cetera. But then ultimately got to be where you had like the major players in even private equity opening some private credit funds and competing with the likes of the big strategically important financial institutions. And now it seems, as we were talking before, like you might have the risks kind of going either back into the SIFIs, the JP Morgan, Citi's, Bank Americas, or residing in the relatively unregulated space of private credit, and it's that super regional bank that has left out. So some might argue that that's actually made this market from the regulation standpoint more risky because it's either concentrated in a few banks or it's into private credit funds. And I mean that's always been a concern, but it does feel like that private credit market, which is one where there's still maybe it's definitely been a bull market there the last several years. But as always, when we see bull markets, we always wonder how much longer that can continue. And I guess that question continues right now.
Yeah, absolutely. And I think on the regulatory environment, there's been talk about loosening up some of those regulations for the banks. So I think that will, impact, where these borrowers go, if that's the case, because the balance sheets now might be able to handle these loans, once again, versus private credit. And there's also been some articles and headlines about some of these private credit issuers getting large enough to be considered, SIFIs themselves,
Yeah.
compared to some of these large banks. So it's all about where the risk lies, and I don't think we've fully tested that yet, about who kind of owns the end risk and kind of where that traces through, and in some sort of a kind of market pullback. And I think that's probably what some of the regulators are concerned about in some of those discussions about really who owns the end risk and how it's going to be impactful. So
For sure. And underlying when we talk about private credit, we always have to think about the private equity markets too. And that's certainly been a hot the hot markets taking a lot of market share even from the public equity markets. And
mhm.
Tony, I don't know if you saw the headline, but Yale University is looking to sell $2.5 billion of private equity. And while I'm talking to somebody yesterday about it, it sounds like it's going to get absorbed pretty easily. Like the only about 98 cents on the dollar, not much of a haircut for
Yes.
selling a big slug. Any thoughts on the private markets? I know you spend most of your time in the public markets, but how are you thinking about and looking at the risks in the private markets yourself?
Well, it's always on relative basis, especially when I think in the CFA Centennial, like a conference, where people mainly discuss about they invite, I think, Professor Steve Kaplan to talk about the private credit market, talk about whether he would make the prediction correct or wrong over the next 5 years with regard to the private credit market, right? Here's actually comes my thought. I think in the past, as what you mentioned, it's like who might be the end buyer, who actually might be the end taker for all of this kind of product. In the past, we can see definitely like Harvard endowment, Yale endowment, they were the main like a taker, they're a risk taker from this particular product. So that being said, is whenever just some kind of financial service or institution comes in and then provide them this kind of a product, they will be the end buyer. But now here, if you're asking any financial institution, PE firm, or any sort of at such a high interest rate when the risk-free was 4.5, the cost of the capital is so high relative to how much they can actually generate the return to justify, to really justify the illiquidity risk premium embedded within this private credit market, right? So it's from my point of view, unless someone has a very deep pocket, this is might be a big question mark. Now here, given the Harvard, Yale endowment, this is all university. I mean, putting aside about their difference or their issues with the current administration, but even for this endowment, owning such kind of asset in such high risk environment rate might not be the most optimal component, like major part of the component within their portfolio. Like even even for a general financial institution with some risk diversification constraint in mind. So I would say here, given the current situation, it might be very tough. So it's definitely, of course, if you sell like a current the maybe nominal value at 2% or 5% discount, my opinion might still be hard. As what maybe I would say maybe have to have more discount to actually to get this out. This is my
Yeah.
thought. Yeah.
It definitely speaks to the dry powder though on the sidelines that they're looking to absorb some of this. And if you're an endowment that might be concerned that your tax status might be changing because of the
Yes.
fighting with the administration, you know that slight discount might look very attractive right now. And speaking of the administration, I mean, on Treasury Secretary Bessent has talked about wanting to reduce regulations for Main Street banks or so the regional
All right.
banks, and maybe that's something more potential dry powder there. But he's also talked about focusing on the 10-year yield, right? And so I wanted to kind of just bring up my Bloomberg real fast and share this and just kind of focus on the 10-year yields. And this is one I was talking before, like asking a lot of people yesterday, when we were around 4.5% in the 10-year, would we see 4.2 or 4.8 first? I think everyone knows my bias is I think it's going to be 4.8 first. But I will tell you that most people I asked yesterday saw 4.2 first. So I would ask both of you, start with you, Blaine, but not putting you on the spot. What do you see as the drivers right now that might take us in either direction, either to 4.2 or 4.8%?
Yeah, I think the market feels to me that we've reached a point of show me. And I think we're not to say we're going to be necessarily sideways, but I think folks are waiting to see what is really going to be the end result here. We've had these large numbers put out there that have been pulled back. We've had deadlines that have been pushed out. And so I think we're in a bit of a just what actually are we dealing with? And now we can talk about even if we got to a level of tariffs that were higher than we started the year with, whether that, is being priced into the market adequately or not. I would tend to think that maybe it's not at the moment. But I think just generically, the market feels like it's a bit of a wait and see and show me. And I think that also implies or translates into earnings as well. We keep hearing that this is going to be the month or this is going to be the quarter where some of these tariffs are going to start hitting some company earnings. I don't know that that's fully been vetted yet and passed through. So the market might be waiting for that. But looking at your chart, I would tend to agree with you, Rich. I would think 4.8 before 4.2. But that's just really coming off of, I think we're going to be at a base level of tariffs that are going to be higher than where we started the year with. And I'm not sure the market's fully priced that in. So.
Tony, any thoughts? Because as I pivot the chart here, I'm gonna look at the 10-year term premium,
Yes.
which has really quite amazingly normalized here over the last several months or last several years, really. But certainly in the last year, it's gone from a negative term premium where we were even halfway through last year to getting back to kind of that 75 basis points, which has basically been the average what we've seen this century, which is
Mhm.
down a little bit from where it was before, but the bond market is if we look beneath the surface, if we look at things like the term premium or the yield curve, and I can show that next the 2-year, 10-year, 10-year, 30-year, the yield curve is steepened and the term premium is steepened. So the bond market is underneath the surface, giving us some signs that maybe it sees a little bit more fiscal risk coming through, whether it's tariffs or it's the lack of spending cuts, the failures of Doge, or maybe it's the extension of tax cuts that aren't paid for. What are your how are you approaching and thinking about the bond market right now, Tony?
Yeah, Richie, you always talk about that fixed income guys smarter than equity guys. So here, I just try to throw some of my thought. Okay, so before for Blaine and you, um, because it's from our point of view, we actually look at some macro factor within the financial market at this moment. There are a couple things. Apparently, one thing is we are going to face about renew about almost like a $6.6 trillion debt. That's one perspective, and the second perspective is like whether we are going to pass what they call a big, beautiful bill, right? I actually sided with Elon Musk. I would say I really agree that bill could be either big or beautiful, but it's very difficult to be together. This is something that I highly agree. Because what we are going to see here is even the big like a spending bill will be passed. Apparently, the stock market would actually see a short-term rally, certainly, no doubt, because under that, if that bill was passed, will pass, that what's going to happen? We're going to see lower corporate tax rate, and this is definitely would actually stimulate the corporate earning per share would increase, the tax decrease, and we're going to see maybe the corporate definitely given this P multiple constant high, making sure this is still the constant, that the valuation will go higher. That's what the market is predicting right now. So you can see that since over the past 1 month or two, the market keep rallying to the point where we are, almost coming back to where we were at the beginning of this year before we actually have some kind of a pullback, correction since the beginning of the year. And I was fortunately to be right on twice of the stock market prediction. Okay, but now here, what's going to happen here? Market is getting super greedy at this moment, and from the sentiments, like from any perspective, market has fully priced in that the bill will be able to pass as it was. It is no, but I have a doubt. I actually cast a doubt to that. That might be the case, and I don't think that might be the case that this bill could be passed without further like a discussion or modification. So given that, that being said, is right now the premium definitely reflect about the tariff, the current market situation, and also fiscal spending bill pending over here. This is definitely need to actually pay higher. So to my point of view, so whether it's going to go to shoot it up to 4.8 or 4.2, market would drive it down to 4.2, and then eventually we realize that it's a failure, then go back to 4.8. That's my prediction.
Okay, that's interesting. Good to know. I mean, and other things that Elon has said, which I thought was a little disconcerting, was that he said, he's come to realization that we have to grow our way out of this and not cut spending, which I find to be something that we hear from DC all the time, and it never seems to work. And it seems that that's what many people, including the equity market, are focusing on. But again, that not just the term premium, but here I'm showing the 10-year, 30-year, which has really accelerated by 30 basis points in the yield
Yes.
curve, and then we see the 2-year, 10-year, which is also accelerated well above zero, and it's getting back to closer to that 75 to 100 basis points average. And usually when we accelerate this sharply, that's when we start to get the recession, as we can see here on the
Yes.
10-year drawn in here. And that's because we have things like this fiscal spending spurts that kind of come out. And what happens is that it's going to stoke inflation, and it's going to mean the Fed can't lower rates the way a lot of people, private credit, but also a lot of equity investors are expecting the Fed to lower rates at least 2 times this year. And I think that creates the potential for risks that the bond market is showing us, that maybe there's some risks there that the equity investors aren't seeing. But
Correct.
again, we go ahead, Tony. Sorry.
Yeah, I think that's definitely correct. I think right now the market sentiments for the equity investor, including both institution and retail investor, are super bullish, and that typically indicated that right now we are close to the recent market top. So controversial to where we actually discussed it in the previous couple episodes when we actually called it like we actually should buy more. That compared to that moment, it was completely opposite direction. And now it seems to me that all of the financial institution in under the umbrella or impression that they're gonna receive the financial deregulation. They're gonna to see the corporate tax cut, the spending bill, the pass, and they're gonna actually we are going to go over the trade war with the tariff trade war with other country, and all of this kind of information has been fully priced in a positive way to a full extent. So this is definitely not a good one, not a good sign.
So now I'm going to bring up the relative rotation graph, which I've brought up before, and Blaine, you and I were talking about this ahead of time. It's always interesting to see how these asset classes and these macro assets are moving. This is over the last quarter or so. The most interesting parts of the chart are always the lower right, where showing the things that have worked that are starting to weaken, and the upper left, which is showing things that have lagged that are starting to improve. And if I zero in on that upper left of things that have not been working that are starting to improve, standing out, we see the Goldman Sachs short interest basket and the IWM. And in just talking to the brokers in the last week in particular, a lot of the demand that they see that's driving the markets to the highs right now is the short interest basket outperforming in small cap, which has been lagging badly, finally kind of catching up, but it also has really high short interest, so that's really contributing to the short interest basket outperforming. So that's not usually when we see those parts of the market leading or bringing us up. That's usually not a sign of strength. But I want to lever a little bit into your recent travels, and I'll talk about mine. But when we think about this rotation here, what are the thoughts that, as you've been talking to people about how they're thinking about maybe setting up portfolios for the next 3 months or the next 6 months? Because we're here in the beginning of June, but those asset allocator meetings they're starting to have them right now about how they want to position for the rest of the year. What are your thoughts on the rotation and we might be seeing?
Yeah, so with my conversations, I was in Lithuania, Latvia, and Estonia, and just these were just cafe conversations when you talk to the person next to you. But so many people are just questioning the why of what's going on, and the when is it going to kind of get to the end result. And so I think there's just a lot of uncertainty in some of those markets. And folks are just looking to us as the somewhat leader that is it has seemed to have caused a lot of uncertainty just globally. And so that was really my basis for wanting to see this chart is just kind of how does that kind of translate into actually what is happening here in the markets, because there does seem to be a lot of folks concerned. Again, just, literal coffee talk, and cab rides and things like that about what's going on over here. So,
Yeah.
yeah.
I had similar conversations in Germany, France, Switzerland, and Austria. And it wasn't just with, it was definitely in the cafe conversations or with the local
Mhm.
tour guides, but it was also with the companies we met. We met with companies in every city. Those are involved in the investment world. It was even with students that we met in some of these cities. They're looking to obtain visas to come to the U.S. to study abroad, and everyone was very, very negative on what's going on in the U.S., et cetera. And that's a decided turn of events. I mean, to hear people so downbeat on the U.S.
Mhm.
We know that global investors are overweight the U.S. because or they're heavily weighted in the U.S. I should say, because the U.S. is a big percentage of the MSCI benchmark. But even then, many were overweight because of the US AI theme. But I think what we've started to see, at least, is a unwinding of some of that overweight. The question is now, with the dollar down 10% this year, will people start to say, maybe we want to not only reduce the overweight, but maybe go a little underweight? And I just zoomed in on the part of the market that's leading right now. And as we look at this, you obviously see crypto and gold up there, but you also see ETFs that are really every part of the world. You got Europe up there. You've got all the developed market ex US doing well. You've got emerging markets doing well. Japan, India, Brazil. You've got every basically market outside the US, which is leading the way right now. And to me, we've got leading markets outside the US. You've got the dollar down. You've got a lot of concern among investors and even just the people on the street that as we go into the allocation, this might be a time for us to think that people might actually start to look to underweight this, even in the strength that we've seen in the U.S. market. What better time to underweight the U.S. market than when you can sell it at higher prices? Tony, what are your thoughts on when you're looking across the world, across the markets, about how investors might be thinking about the U.S. versus the rest of the world?
Yes, apparently I can understand the uncertainty seen by many like it's financial institutional investors outside of the US with regard to whether they could continue to overweight their asset or allocation into the US financial market. But if we actually look at the long run, if what President Trump pushing, it's really working. Suppose we have a lower corporate tax rate, we have high tariff if it's not made in the United States, and everything. If this is kind of a action take place, I would anticipate it that the U.S. market will still be the best place in the world to actually continue compared to the rest of the world, and the capital will come back. But we also mentioned, I think in the last episode we discussed that if we try to identify a place where we see the relative value, a strong deep pocket value, that's just China. And since our last episode, the China stock market and in Hong Kong and in the mainland China has also picked it up as well, which actually can reflect quite like KWAP, FXI here. They are the
Yeah,
leading.
that's in the weakening category though, Tony. So that it's definitely assets that have done well, but are actually starting to weaken
Started
on a
weakening, yeah,
relative basis. Yeah.
but you can see they are turning around. They are turning around.
That's an optimistic interpretation, but I can see what you're saying in the last week that maybe they look a
Yes.
little better than the previous 11, but
Exactly. So my interpret my emphasis will be I think diversification still play a very critical role like until the end of this year. I would say maybe having more allocation to Asia, China, India, and allocation to Bitcoin, which like people see it as risky, but now with the bill Genius Act, if like a pass, that we definitely will see is like another booming drivers for cryptocurrency. Bitcoin will continue to, I think, overweight the U.S. stock market equity, especially I would say the large cap under the current high interest rate environment. because we have continued to see the inflation remain high, no matter how we come down, as long as it's above 3%, it typically would kill the profit or the revenue generation capability for many of the small cap company, especially the healthcare biotech. So in that sense, I would argue for maybe allocation to large cap tech, like M7, the one that we typically see in China, Bitcoin. Yeah,
Okay.
that's
Blaine, your thoughts on that?
Yeah, I would just take a little more of a macro sense. I think what Tony hit on something a little bit earlier, even your comment about underweighting, to the benchmark slightly. But I think going back to what the U.S. represents, the largest, most liquid, most efficient capital markets system in the world, you know, I guess the question I ask, and we were talking a little bit earlier about this, Rich, is I agree that to the extent you're going to have some rotation away from the U.S., it's just how much and how much has already happened. And you can't, you obviously can't go to zero, and you can go underweight, but it's just that delta about how much, do you want to underweight and, not be exposed to what is the largest and still performing economy in the world, and if some positive things do happen, the markets are going to react fairly quickly. So the bull, our 4.2 versus 4.8 discussion earlier on bonds, or do you want to talk about equities? If we do get some positive trade talks, that the market views as positive, and you're way underweight the U.S. I mean, is that a position you want to be in when things kind of revert back to go in the opposite direction? So to me, the question is, again, you rotate out of the U.S. We've heard about that, but really, how much more is there left of that trade?
No, that's a fair point. It's a
Yeah.
fair point. If we look into the lagging category, just to kind of tidy this one up, we see all sorts of bond ETFs. We see the aggregate, we see LQD, HYGs in there, we see TLT. So the bond market is definitely lagging the equity market, and so
Mhm.
we definitely have that. Investors may be looking at this when we look at the fact that bonds are lagging and crypto and gold are leading. Is to me it's just another indication that investors are suggesting that we're not seeing the fiscal restraint that we wanted to see, and so the argument, as I heard from some people, some Bitcoin investors and crypto investors in Switzerland, of which there are many, it's a crypto valley that's developing there. The arguments in favor of crypto because of lack of fiscal restraint are stronger than ever. And it's not just a US thing, it's a global thing, as we see with what's going on in Europe as well. And then we're seeing that reflected in the kind of the gold and the crypto points, but you're also seeing that in the bond market. And just one thing I want to kind of show you, Blaine. I put up this chart. This is just the MSCI World versus the S&P over the last 15 years, really in the post-financial crisis
Mhm.
period. And you saw we've seen a very sharp move higher, as you can see on the far right, very sharp move higher in the rest of the world versus the U.S. this year. Something on the order of when looking, 15% relative or whatever. But in the grand scheme of the last 15 years, that still would suggest that there's a fair bit more that could go on. Whether it will or not, we don't know. But um, you know, it does from the trend, just drawing some very simple trend lines lower, it suggests that maybe there is a little bit of a breakout and a change in mindset that could be occurring here, and more that could happen. Will it happen? We don't know. What are the imminent catalysts, et cetera? That is clearly the argument. And I think if I looked at a similar chart for the emerging markets versus the S&P, you see the same thing where even where you see some outperformance, it is really just a drop in the ocean right now. And so um, I think if you're looking at that and you're a long-term asset allocator, you might be saying, well, maybe I've missed it in the first half of this year, but there could be more to go if we think there's going to be a continuation of these sorts of trends.
Yeah, yeah. Certainly worth paying attention to. I'd agree. And it gets back to that delta and how much I think how much you really want to allocate away. from, again, the largest, most liquid capital markets out there. So
Yeah, for sure. And I just want to
Yeah,
kind of
I agree.
pivot to one last thing. Go ahead, Tony. I'll give you some thoughts, but I want to
I agree. I think it's actually quite difficult to actually deviate from the US stock market, even though maybe just recently there might be a spike as what you show, which was a very nice chart, Rich. But overall, I just see no driver like for the emerging market would continue to outperform relative to the US stock market from either innovation, physical, or geopolitical. I see no drivers for that.
Well, maybe I'll show you a driver here, Tony. Let's see.
Okay.
I've got a chart because I know you're the resident AI expert on this call. AI is going to solve all of our problems. It's going to drive costs lower. It's going to drive productivity through the roof. And that's what we hear. And that's why we see
Yeah.
companies from anyone from McKinsey to Microsoft firing 10% of their workforce, right? Um,
Yeah.
However, when I look at the data that's come out this year, I see unit labor costs here in white going much, much higher. And I see labor
Uh-huh.
productivity collapsing, which is the exact opposite of what I would expect to see if AI was solving all of my problems. And so, other than the fact that ChatGPT does a really good job of getting me recipes when I find the ingredients in my refrigerator, I don't know what to do with it. What problems is it solving, or is that still on the come, Tony? Are we still going to get these earnings growth? But right now, what I'm seeing is that margins are not being saved, and that's why companies are having to fire a lot of white collar workers. And we see that even Procter and Gamble said it's going to be cutting 10% of its workforce, all focused on the white collar side of it. So the white collar is under siege right now from AI, but I'm not seeing in the data where AI is really fixing things just yet.
This is a very interesting chart, by the way. Okay, so from our research, we actually what we have seen here. This is very contradictory um, result that those company which typically embrace technology innovation, which means they continue to invest their R&D in based on the percentage of the revenue, we continue to see higher capex into the AI versus a company which actually you can see like will be non tax driven business like Home Depot, Walmart, and they would not actually spend any additional actual R&D or capex into the AI. So here, if we actually look at this kind of a non-farm payroll business, I think it will be some kind of aggregation. What it typically show, the draft here, what it typically show here, could be a couple of reasons. First, the cost, union labor costs will continue to go higher. Yes, because the inflation is higher, the salary increase still remain positive over the past quarter. So this data have shown. So but on the other hand, we continue to see that the Max 7, M7 company continue to lay off, including the big corporations continue to have lay off people. So we see less and less of the labor within the big M7, but simultaneously they will replace them with more of like or I should say, some less of the junior people. They will continue to hire, but hire less. And similarly, on the other hand, like in the service industry, like restaurant, healthcare, is kind of where it might be some labor intensive, we continue also see the salary or wage going picking up higher over there. So in this chart, overall generalized, show me that I think we see some proportional increase in the employment rate at this moment, which actually will go towards where typically non-tax driven sectors versus tax driven sector. So that's how I interpret this, Rich. Right.
Yeah, so if we look at all the labor data that came out last week, the market might cheer that it looks pretty good. Now, of course, as always with the non-farm payroll, there are massive revisions, as there always are, which is why I don't know why people care about it. But that all of that is said, if you look into the weeds and you break things apart, what you find is that Where we are seeing jobs is in the government sector and in the healthcare sector.
Yes.
That's, people taking care of aging boomers. And where we're not seeing job growth, in fact, where we're seeing unemployment rates rise, is in the financial services and technology. And in fact, the unemployment rate in the age 20 to 24 just hit 6%, which is the highest it's been, I think, since the financial crisis, perhaps. And as we know in
Correct.
talking to students, the job market is not particularly robust for our students. I'm not so sure that when I go back this fall, I want to talk to them about getting into working in healthcare, or taking care of aging boomers. I'm not so sure that's what they were looking to do with their college degrees. But Blaine, when I look at this, I think persistent and sticky inflation, which is going to kind of tying it back, which is going to impact Fed policy, which is going to keep rates higher, which is going to hurt private credit, which is going to get us back to that 4.8% versus 4.2%. But what are your thoughts when you see something that looks like this?
Yeah, I'm looking at that rate of change on that white line. The unit labor costs
Yeah.
is much higher than the productivity line, and therefore, I read that as your costs are increasing faster than your productivity line. And companies, as you went through, there's been some layoffs. They maybe aren't as hiring as much, and it's just impacting the overall productivity that you're seeing out of the workers that you have. And we haven't seen the benefits of AI quite yet. But when I look at this chart, I look at the rate of change on that unit labor cost, and I see that as inflationary as well. And
And
concerns about the conversation we had earlier about the 10-year, but also about the Fed's ability to move on rates, and what the market expectations are for this year might not be what we're going to see. So things along those lines.
so I see this, and I look at this, and I look at a lot of the data that's come out, and I see stagflation. I see
Yeah.
slowing growth to below trend levels. I see rising unemployment, and I see sticky inflation, which is your textbook example of stagflation, which tells you stock markets in general lower, bond markets lower, and the sectors that should be working, such as energy and healthcare, et cetera, are not working right now in the markets. And things that shouldn't work, technology and consumer, are what's driving the market higher. Tony, I'm going to leave you the last word because you're the technology bull here. If we are going to see something that resembles stagflation and not a new bull market, um, don't you see any risks at all to the U.S. technology
Uh,
story?
yes, if we that does happen, that will be a disaster for the overall stock market. But given the current situation, to see if there are any kind of maybe what I should see the headwind for this thing to happen. Apparently, we see so far the risk-free rate is so high, which definitely means like Fed has a lot of weapons. Fed puts in their hand. Secondary, the government, President Trump really is a business pro type of person. So a lot of the like tax policy might continue to come out, even though might not be passed about the bill at this moment, but we'll continue to see more of the corporate tax be reducing, less of regulation over the corporate would also stimulate the business. So in my sense, the chance or the probability for this to happen might be very rare. And given what AI had already shown to us, which are extraordinarily from every single industry that we have seen that where I have been working with. So with many folks like within different industry continue to adopt the AI, we'll continue to see the high productivity going forward. And but that being said, is the chance for me, I think to see this stagflation might still, even though it's there, but it's relatively low. We will continue. Well, I would anticipate it. We'll see a positive outcome from the current situation if President Trump can actually settle the argument with China, the two largest economy in the world. If they can actually settle the tariff argument, this is because this will be fantastic. China can export deflationary deflation instantaneously, right? Everyone knows that. So, which means we have solution, but it depends on whether we are going to look at it from a win-win situation or we are going to look at just single wall, or however we want to look at it. There's a solution, but there are definitely different issue can political, geopolitical can and party view can actually happen right here within the United States.
One big beautiful deflation. So Blaine, I'll give you the last
I like that,
word
right?
here. I'll take the other side of Tony's views there, but I'll give you the last word. You'll be the deciding vote.
Thanks. Yeah, yeah. Yeah, I'm probably a little more concerned than Tony is on the probability of stagflation. I do think you know, there seems to be some signs of inflation sticking around. I don't think we're going to get the Fed cuts that the market thinks we're going to get this year. I think that's a bit of a risk, and the employment situation seems to be slowing, and or at least we're seeing potential some signs of that. And just all that leads to potential slower growth, and that's stagflation. And so there's so much out there that can change just as far as the dynamics of the market tenor and what drives that as far as the headlines that can change. Tony just outlined a big one, the talks with China. That would be a huge, boon to the markets, and just generally, I think people's outlook, if something were to come positive out of that, and certainly could change the outlooks there. But going based on the data that we have, I probably put the probability a little bit higher than Tony does in stagflation. So.
Well, I think the best thing to do then is going to be to reconvene the three of us just after the FOMC meeting in about 8 or 9 days, and we'll see what Jay Powell thinks about the risks
Yeah.
of stagflation, whether he agrees with Blaine and myself or whether he agrees with you, Tony. So for that, why don't we leave it there? It was good to catch up with you guys. It's been too long, and then we'll try to do this again a little bit sooner, especially after we have some catalysts such as CPI coming out tomorrow and the FOMC next week, and then we kind of get into seeing what's going on in the early parts of the summer with how the markets are moving.
And PPI later this week as well. So
Yes.
a couple of big numbers this week.
Yes.
So to pay attention to. Yeah.
Earnings coming up as well.
Okay, well, thanks everyone. Thanks for
guys.
joining us. Thank you, Tony and Blaine. Always good to be with you. And we'll leave it there for now.
Yeah. Thank you, Rich. Thank you, Blaine.
Thanks, guys. Thanks, Tony. Thanks, Rich. Yep.